Hi everyone, I'm here today to talk about how to never sell your Bitcoin. I want to start off with apologizing for the background. I'm on a family vacation, and so this was the only place I could record that had good light. And before we begin, I want to give a shout out to Ledn. Ledn is a product that I use personally. It's a great way to lend and earn a yield on your Bitcoin or borrow against your Bitcoin using your Bitcoin as collateral for a loan. Definitely recommend that you check them out. It does come with risk, so make sure you go read about it and do your own research. All right, now let's go ahead and hop on in. So I write this first. This is the Held Report, my newsletter that I send out every Thursday. And this one is on how to never sell your Bitcoin. Let's go ahead and dive on in. I've been a hodler since 2012. Not a perfect one. I'm not going to say that I hodled every coin perfectly this whole time. But I did my best and did better than most. Most folks either sold, panic sold, or got out, or traded it for something else. And in the early days, we thought that hodling would just be. I mean, we us early hodlers thought that like it'd be incredible if Bitcoin just survived. The idea that it could become Gold 2.0 or a world reserve currency almost seemed impossible. But right now we're on the cusp of that happening, and the question is, you've got this wealth. Now, what do you do with it? I don't want to sell it. And we've been conditioned to hodl no matter the volatility, no matter the FUD. So what do we do with it? About 2 years ago, I began this journey of like how to never sell my Bitcoin, but maybe live off of my Bitcoin. I want to hodl my coins all the way through hyper Bitcoinization. If I sell it for something, I feel like I'll miss out on the upside, and I'll decrease the price because it's selling pressure. Now, note that these two strategies I'm going to highlight aren't risk-free. Every strategy has risk, including hodling. Hodling assumes that you manage your private key correctly. It also assumes X, Y, Z other thing about the Bitcoin protocol. But in the next sections, I'll try my best to lay out the risk-reward for these two strategies of borrowing and lending. Okay, so the first one, borrowing using your Bitcoin as collateral. This is also called margin. Essentially, you post Bitcoin as collateral, and the lender gives you another asset, say dollars. The lender will charge you interest. In this case, it's interest only on this loan. It's not, you don't have to pay down the principal. And they hold your Bitcoin as collateral for the duration of the loan, which can, of course, be paid back early. This type of strategy is very useful because you receive some value of your Bitcoin without realizing a gain via selling. However, there's some risks involved. Maintaining a healthy loan-to-value (LTV) ratio. Let's say you don't over-collateralize your loan enough, you might be liquidated if the price of Bitcoin goes down. For example, if you borrowed 50K in USD using $100,000 worth of Bitcoin as collateral, if Bitcoin's price falls to a certain level designated by the lender, you'll get margin called, which means you either have to pay down the loan, so the fiat that you borrowed, or post more collateral, otherwise you'll be liquidated. And so, this is a really, really tricky situation where I think this is the number one thing to focus on if you try this strategy is making sure that the loan is very over collateralized. There's some other risks here too. Servicing the debt. Can you pay 4 to 10% interest rate on the loan for the duration of the loan? If you fail to make a payment, they may sell part of your collateral and then you'll owe taxes. Custody. The lender will also custody your Bitcoin for the entire duration of the loan, which means if they get hacked or have an accident, you could lose your Bitcoin. Now, you still have the dollars that you borrowed, but you won't have your Bitcoin. Many lenders offer a lower rate, around 4%, because they rehypothecate the collateral. For example, companies like BlockFi do this. I personally use Unchained, which does not do this. Unchained Capital does not lend out your Bitcoin to subsidize that interest rate that you pay. You pay the full interest rate. Also note that with tax, if you get liquidated, if you've already spent the loan on something, let's say you didn't use it to buy another asset, you could be stuck with a super large tax bill and no way to pay it. Also, there's a very small chance the IRS could consider any collateral that has been rehypothecated, say the BlockFi method, as a sale, but this looks pretty unlikely. Now, again, I'm not a tax advisor, but you should consult a professional when looking into this. And the providers for retail, so the regular ordinary people, they got a great tool called B2X for the hodlers who want to go levered. They essentially want to go levered and buy more Bitcoin, so they borrow against their Bitcoin and then immediately buy some. That's what they specialize in with the B2X product. Unchained, I personally use these folks. A big value prop for me is that they don't rehypothecate the collateral. And then BlockFi, that's a very popular place to use. I do have affiliate arrangements with those two companies, so just make sure that I just want to make sure to call that out. All right, now earning so one way, so you could borrow against your Bitcoin using your Bitcoin as collateral, And then the other way is earning a yield on your Bitcoin, so having your Bitcoin throw off a return. One of my favorite quotes that encapsulates what earning a yield on your Bitcoin and like where that comes from is from Judith Chow. She's the former CEO of LedgerX. Now she's currently at Kraken, but she's got some phenomenal thoughts on markets, trading in general. She was an ex-derivatives trader at Goldman. So her quote, yield generating strategies are usually short some sort of tail risk. I love this quote because it encapsulates all yield. All yield is monetizing some level of risk. And so a lot of folks think that, okay, I'll just, I'm taking on risk, but it's not that big of risk. Well, you're essentially getting paid for some sort of risk that you're taking on. And over the last 2 years, I've personally experimented with different lending services in the crypto space. There's a spreadsheet here, so it's linked, and I'll link it below here in the video. This spreadsheet is a really great way to go look at what I personally have my coins, and then also look at the variety of services that you can use and sort of my personal feelings on why I would or wouldn't use them. So earning a yield for me, you can either stack more sats, which is what I'm currently doing, or reduce the temptation to sell Bitcoin because you can earn an income. Now, I want to cover risk first here before we delve into the different strategies. I cover risk in the beginning because I want everyone to focus on what can go wrong before they make the decision to go into this. Lending and borrowing, these are some of the oldest forms of finance. When you lend out your Bitcoin, the return you earn is compensation for the risk you're taking with your capital. I mean, there is no such thing as a risk-free return. Now, taking risk isn't a good or bad thing. It's inherent for any investment, even Bitcoin. An investor essentially hopes that they've appropriately sized the risk relative to the return, that they've identified that they've found a very low risk bet that has a higher yield. So all investments require risk. Just keep this in mind. Now, there's a couple of things that are a little bit different than traditional investments. There is no necessarily benefit to diversification because we don't know the counterparty overlap between Ledn, BlockFi, and Genesis. Some people ask me if they should use a lending service that has a token like Celsius or Nexo. I personally wouldn't. I think that adding a token increases regulatory and structural risk. Most of these aren't regulatory compliant. For example, like they've only filed a certain sort of form, which isn't the right form to file, or they claim that they have insurance, but really this is just BitGo's insurance, which covers all of their custodial partners. Also, one of these blew up earlier this year called Cred. Now, in the sections below, I'll be covering traditional finance, so centralized finance ways to earn yield and decentralized yield solutions. And I'll only expand on a few of the potential solutions in each category because I don't have all the time in the world to go through each one of them. Now, again, note that there are referral links for some of these links that you'll use. I do get compensated if you use some of these services. In the sheet, I've marked services that I personally use. All right, traditional finance lending platforms. Companies like Ledn take your deposited Bitcoin and then lend them out to exchanges, hedge funds, miners, etc. A Bitcoin bank, if you will. As I mentioned previously, I don't recommend any solution that has a token as it increases the risk with little benefit, and that's why some of those are marked in red. So the yield you're looking at is between 3 and 6%. This depends on different market conditions. Type of risk you're taking, the type of risk is known, but what is unknown are the counterparties, who they've lent the coins out to. There's also custody risk. Knowing one counterparty in exchange like Bitfinex might be lower risk than not knowing multiple counterparties, for example, like with Ledn, but the fact is you just don't know. Liquidity, this is one of the most liquid ways to earn a yield on your Bitcoin, so if you have a lot of Bitcoin in size, this is one of the easiest ways to move in and out of that position. In ease of use, almost anyone can sign up, deposit, and start earning yield in a few clicks. And then here's how to do it. Again, I'll include links to these services in the notes below, so if you want to check the description below, I've got those there. All right, so that's traditional lending. Now you've got margin pools. So with margin pools, you lend your coin to the margin pool of the exchange. Now, what's beneficial about this method is that you understand your counterparty risk. You know the exchange you're lending your coins to. A good example of this is Bitfinex, and below here are the daily funding rates since 2018. Now you can see that they fluctuate quite a bit depending on the market. Currently, the annual yield is only at 0.3%, which is pretty damn low. But it fluctuates a lot. At times, sometimes the borrow rate was almost 1% a day, which is really insane. That was when a lot of folks were likely shorting. Again, these different services are linked in my yield spreadsheet. They also have, for example, exchange margin pools also exist at Poloniex, FTX. I do not recommend Poloniex. They got hacked and socialized loss, but FTX and Binance as well. Yield fluctuates a lot between 0.1%, 10% on average, depending on the market conditions. Type of risk, you're lending your coins to an exchange, so you have to trust in the exchange. Now, if an exchange makes enough money, if there wasn't a flaw in how they essentially manage that risk, they could plug it with a bunch of their cash on hand. So that's one thing to keep in mind. Liquidity, you can enter and exit in reasonable size, low millions, spread out over time. Ease of use, almost anyone can do it on those exchanges. And then how to do it: sign up with an account at Bitfinex, deposit Bitcoin, and place your order. Cool. So we've covered lending platforms. We've covered lending your coins out to a margin pool. Now we're going to cover covered calls. Okay, so what are covered calls? It's an options trade where the owner of the underlying asset, what's called covered, sell their upside above a certain price called the strike price in exchange for a payment called a premium, aka the yield that you're generating here. So the simple answer for the expected yield on the strategy is that the higher the yield is, the more likely the event is perceived to occur. And so the more complex answer is that the yield is dependent on how far or close away the strike is from the current price, implied volatility, and other factors. At the end of the option time period, the expiration, if the current price is higher than the strike price at expiration, then the seller of the covered call option has to sell their coins at the previously agreed upon strike, no matter how high the current value is. But they keep all the value up to the strike. So whenever they wrote the contract, whatever the value of Bitcoin was then, all the way through the strike, they still get that appreciation. At the end of expiration, if the price is lower than the strike, then the seller receives their Bitcoin back and they get to keep their premium. So that's the optimal scenario, is that you sell a covered call if you're the holder of Bitcoin, because you're the seller of the covered call, that you sell at a value that you don't expect Bitcoin to exceed. So you have a strike value of, say $100,000 of Bitcoin in a month. You get to keep the premium and your Bitcoin, so you get your Bitcoin back. Now, what does this look like with real numbers? This was pulled June 8th, split spread. So split spread is the median price between the bid and the ask. So for a 60K strike expiring in September, it's a $1,400 premium, which is a 13% annualized premium. For September, a $100,000 strike is a $358 premium, which is a 4.4% annualized yield. Not too bad. Just depends on what your risk tolerance is and if you're willing to sell your Bitcoin above that price. Of course, that's the bet that you're making, is that Bitcoin will not, the TLDR is the bet that you're making is that Bitcoin will not be above a certain price at a certain time. Now, annualized is a bit of a misnomer, since you don't know what the yield will be next time you sell the covered calls. So these are the best estimation. And like, for example, the yield changes because of implied volatility and other market factors. So it really, really fluctuates. Now, the yield here, 1 to 80%, depends on how far away the strike is plus volatility. What's particularly exciting about this type of investment is that you earn your yield immediately, regardless of the expiration. This means that your return could be higher than just the yield from covered calls, as you could reinvest it into any investment immediately. Now, with exchange margin pools and the lending platforms, you just receive that like monthly or daily. You don't receive a lump sum payment for all of that yield for the entire duration. So that's really cool. Also, you understand your risk exactly. So on the type of risk, you know exactly the sort of risk you're taking. It's basically just custody exchange risk. There is technically no counterparty risk other than the exchange getting hacked. And the risk basically you're taking price risks, that the price of Bitcoin won't be above a certain price. And liquidity, depending on the exchange you use, I think liquidity here is the big problem. The ability to get in and out is decently easy, but depends on the exchange that you use. LedgerX is a little bit less liquid than Deribit. Deribit's a very liquid platform. Now, ease of use, selling covered calls is quite easy once you understand the fundamentals. However, there is a mental blocker to entry. It kind of feels, a lot of people feel that it's a little bit funky. They kind of see this whiteboard, like they imagine like a beautiful line with a bunch of numbers on the wall. It's not that complicated. Spend the time to go read up a little bit more about how covered calls work. How to do it: you can sign up with Deribit. You get 10% off trading fees at this link. Again, I'll have this below. You can fund your account with Bitcoin and sell a covered call. That easy. Before we go to the next section, which is decentralized finance or DeFi, I want to give a shout out to my other sponsor, CryptoTag. CryptoTag is the best way to store your Bitcoin backup. It's on Titanium. It's fireproof, waterproof, crush-proof. I personally use the product. I highly recommend it. Check it out. The link is below. Okay, now back to the article. Decentralized finance. So decentralized finance. These are ways to earn a yield where there's no centralized party that you have to trust. Now, Bitcoin has actually had DeFi-esque tools for a long time, starting with Join Markets a long, long time ago. So I'll start with those first. Join Market is a CoinJoin implementation which allows Bitcoiners to obfuscate their Bitcoin holdings by mixing them with other Bitcoiners. In order to create a robust market for individuals willing to mix, there are makers and takers. Makers post coins available to mix. Takers come on and they're like, I want to mix right now, and they pay the makers for that convenience. Now the yield is really, really low. We're talking like 0.1%. I wrote this as 0.5, but it's really more like 0.1% to 1% max. The only risk here is that you keep your coins in a hot wallet, but I think this is a very, very low risk. This is almost as low as you can go. And you also keep in mind that some of these activities might be deemed illegal in some countries, so you need to check your local regulations. Again, Bitcoin's a permissionless network, so I don't think you need to worry about that. Liquidity-wise, a little bit less liquid than the other solutions here. You can check the market depth at any time to see what fees you need to be paid. They will see what fees are people willing to pay to mix their coins. If you're trying to earn a yield on a sum larger than $1 million, you probably won't have it won't be that easy to do here. You can withdraw your coins at any time. Ease of use, out of all the available options, it's definitely on the harder end of the spectrum. Here are the instructions how to do it. Again, I'll link to all this later, so you can go kind of read up on this. Now, Lightning Pool. Lightning Pool is a really cool new implementation done by Lightning Labs. Essentially, it's an order book for Lightning liquidity, or a channel marketplace done in a non-custodial manner. There's a coordinating server, but semi-non-custodial. Each channel lease has a few parameters. There's an auction, and essentially the premium that people pay is basically people paying you for channel liquidity. The premium is a one-time upfront payment. In the future, it might be in the form of streaming payments per block. GitUmbrel is a great node software to run your node, and they have enabled Lightning Pool and a nice visualization here, so it makes it much more approachable for non-engineers. Now the yield, it's only been running a few months and has super low liquidity, probably long-term less than 1%. You can check out some of the recent transactions. I'll include that link below. Type of risk, the code is very new and there's a good chance that there might be a flaw. Liquidity is super low. Ease of use, there's a UI now with GitUmbrel, but it's still brand new. Here are the instructions. I hope we didn't run through this too fast, but I want to make sure I touch on everything and didn't have people get bored. I think there's a lot of great both mainstream traditional finance solutions and decentralized finance solutions to earn a yield on your Bitcoin. All of these come with risk. Take some time to learn more about it. Don't just take my word about it on it. Hope you enjoyed it. If you like this, please subscribe. That helps me out a ton to get out the word about these different types of things about Bitcoin. And make sure to tell everyone about it. Cheers. Bye.